Hello and welcome to chapter 26 videos. This is the last chapter in the textbook. This chapter is about capital budgeting, capital investment. So mostly when we look at capital investment decisions, we're looking at purchasing plant assets, new buildings, building new buildings, buying expensive equipment, but they can also be used in developing new product lines, purchasing other companies, etc. The biggest thing to know is that it's a very large financial commitment to companies, and the decisions can't be reversed. So once you've made a commitment to purchase something and committed those funds, you can't change your mind about it. So companies need to be very strategic when they're planning which capital investments they're going to go forward with. Capital budgeting is a way that businesses look at future investment possibilities, any future projects they might want to take on, and they budget that into their current budget process. So many capital budgets look at a 5 to 10 year period, and then they look at what portion of those things need to be paid during the current budget cycle, how many projects could they potentially take on. They will rank them, they'll decide how much funds they can put towards these large capital investments, and they choose plans from there. Some non-financial factors when we're talking about making capital expenditures. We might have environmental concerns. We might be trying to improve our corporate image. So these are just some examples of what a current investment proposal might be and the different non-financial considerations that might come with that proposal. As with any proposal, we know that there are financial and non-financial considerations that come into play anytime we're working with people. So we're going to look through this example of this company, a minor league baseball team. So this is the example from your textbook. They're trying to decide between two different possibilities. So the first one is they're looking at purchasing vending machines for their stadium. And the second one is that they're looking to purchase a new bus. So one of the reasons that we have to evaluate and rank capital investment ideas is that we don't have unlimited funds available to us. So no company has unlimited funds to just go out and spend whatever they want on anything that they might want to do. So they need to evaluate and decide which ones are the best options for the money that they do have available. So they don't have a concession stand. This is one of the reasons that they've been looking at maybe these vending machines. So first of all, they went out and they looked at what would it take to construct a concession stand. And the proposal that they got for building a concession stand was a lot more than they wanted to spend. So they started looking at other options for how can we sell food during games without committing to a concession stand that we don't want to spend the money for. So they received this proposal for 10 vending machines. It's going to be the full budget that they want to spend. They're going to be stocked by Vendicorp. There's a 5-year estimated life, and then the machines will be purchased back. There's also insurance and maintenance contract on the machines for their 5-year life. We need to estimate how much money we think we're going to make on the machines, how much the machines are going to cost us. So we estimate that we're going to make about $1,875 per game. We have 45 home games per season. We can generate annual revenue of almost $85,000. We're going to pay 60% of sales to Vendicorp, and we're required to reimburse them only for the items that sell. So we're not required to pay them for everything that they put in the vending machine, only the items that sell. So we've prepared this sheet that looks at how much is our actual increase in net income from this investment. So we have to consider many things when we're looking at what the potential cash flows might be. So we already know we have projected revenues from selling food at games from the vending machines. That comes with a cost of goods sold that we have to pay 60% of our sales to the vendor company. So we have a 40% increase in annual gross profit. Then we have depreciation, the maintenance and insurance contract that we have to pay, and any increase in utilities and other costs that might come with taking on these vending machines. We consider our income tax amount, and we calculate that we're going to increase our annual net income $10,000 a year by putting money into this investment. Is that going to be enough income generation to offset our $75,000 investment? So when we're analyzing those net cash flows, as we were doing over here, we have to take a lot of things into consideration. Not only the potential revenue that might be coming in, but then the expenses that come in with that investment also. So here we have that our annual net income from the investment is $10,000. We have an annual depreciation expense of $14,000. So our annual net cash flows from the investment are $24,000. Because if we remember, depreciation is a non-cash expense, so it gets added back to determine what our annual cash flows are. When we're looking at whether or not those cash flows are enough to justify this expense, we have several different methods that we can use to analyze capital investment decisions. The first method is called the payback period. This is the amount of time it takes to recoup what we paid. So we take the amount to be invested divided by our annual net cash flows. And in this example, we see that it's going to take just over 3 years to pay back this investment. We know that the machines are good for 5 years. We usually want a short payback period because the sooner that we can recoup that money that we paid on that investment, then the sooner that we can move on to other investments. We also avoid risk if we use shorter payback periods. Most of that risk comes from any kind of economic conditions that prevent us from recovering the investment. For example, think about this year where we have the coronavirus canceling everything. If they had decided to install vending machines, made that $75,000 investment this year, and then all of their baseball games were canceled because of a global pandemic, they would not recoup any funds in the first year of that investment. Another thing that we have to think about the payback period is that it shouldn't be our only factor because it only considers how long it takes us to recoup our money, and it doesn't look at any cash flows that happen after we recoup our money. The other thing is that it ignores time value of money. So we're going to look at this example for the payback period. So we're trying to decide if we're going to go ahead with an investment opportunity that costs $90,000. We have incremental cash inflows of $50,000 and incremental cash outflows of $32,000. So we need to determine what the payback period is. So we take the amount to be invested of $90,000 and divide that by the estimated annual net cash flows. Well, the estimated annual net cash flows are $50,000 minus $32,000. So if we were trying to determine that, we would take 90,000 and divide it by 50,000 minus 32,000. And we get 5 years. We can extend that out to see if it's a portion of 5 years, but it's just exactly 5 years. So all we know now is that if we were to move forward with the investment of $90,000, that we would pay it back in 5 years. Is that a good investment or not? It really depends. One of the things that it depends on is what if this investment was only good for a 3-year period? It would not be a good idea to invest in something that's only good for 3 years if it's going to take us 5 years to recoup our money on it. So we need to know how long the project lasts and what the project is for in order to make a better decision about it. When we have unequal cash flows, we need to look at each year individually. So we see in this example that we have uneven cash flows every year. We have a machine that costs $16,000 and has an 8-year useful life. So we make a chart of those cash flows for the payback, and we calculate that in the first year we get $3,000 in cash flows. So then after the first year we have $13,000 left. We go until we are almost at the payback. From this chart we can determine that the payback is going to happen sometime between year 4 and 5. Because we only have $1,000 left at the end of year 4, and we're going to make $5,000 in cash flows in year 5. So we take the remaining amount, that $1,000 at the end of year 4, and divide it by the cash flows in year 5, as you can see down here, and we find out that the repayment is 4.2 years. We might also have different depreciation methods. So we know that depreciation methods affect our payback period. So we have this machine that we're looking at that can be purchased for $150,000. And we're trying to determine what the straight line depreciation is and what the machine's payback period will be. So whether we use payback or double declining balance. So first we're going to use straight line depreciation. And we're going to look at our years. Because I'm trying to reduce the length of these videos, I'm actually going to save this example for the next video and pause here.